Patricia had spent 32 years teaching high school math in Arizona. She was 61. She had a $480,000 traditional IRA, a small pension lined up for retirement, and 4 years to go before she expected to leave work. She believed she still had lots of runway. She was thinking ahead about Social Security, about Medicare, about when to stop putting money into her IRA, and when to begin pulling it out. What no one had ever explained to Patricia was that age 61 is not just another step on the path to retirement. It is the single most important tax year of her entire retirement timeline, and she was using it the way almost everyone does, by letting it drift by. When Patricia finally met with a retirement-focused tax planner at 63, 2 critical years had already slipped away. The specialist ran projections and showed her exactly what those 2 years had cost. Because she did not complete even one Roth conversion at 61 or 62, she had skipped the lowest tax bracket window she would ever see again. Her Medicare premium at 65 was now on track to be higher because of income she reported at 63 that she could have avoided, and her IRA balance had grown larger, which meant her required minimum distributions beginning at 73 would be larger as well, pushing her into a higher tax bracket for the rest of her life. 2 years of delay, one lifetime of impact. This video is strictly for education and illustration. It is not tax or financial advice. Always speak with a qualified tax professional before making choices about your own situation. My name is Kevin Retires. Each week I unpack the tax code, the hidden financial pitfalls, and the strategies that help retirees avoid traps most people never see coming. If that sounds like something you can use, hit the subscribe button right now and turn on notifications so you never miss a new video. In this video, I am going to walk you through exactly why age 61 is unlike any other point in your retirement journey. What specific moves are on the table at 61 that become far more complicated at 62, 63, and later? And what the financial penalty for waiting actually looks like in dollar terms. Let us begin with why 61 stands apart. Most people think of retirement landmarks as certain ages when something official changes. 59 and a half is when you can start taking IRA withdrawals without early penalties. 62 is when you first become eligible for Social Security. 63 is when the Medicare income look-back window starts to matter. 65 is when Medicare coverage actually begins. 73 is when required minimum distributions kick in. Every one of those birthdays has a specific rule, a benefit start date, or a monitoring system hooked to it. 61 has none of those labels attached, and that is exactly what gives it its strength. At 61, you cannot claim Social Security yet, which means it is not part of any of your income calculations. At 61, the IRMA 2-year Medicare look-back has not started, which means income you recognize now will not affect your Medicare premiums when you sign up at 65. At 61, required minimum distributions are still 12 years away, which means you control exactly how much you withdraw and when. No forced withdrawals, no automated rules dictating your moves. At 61, you stand in the final year of complete financial quiet, and most people waste that silence by doing nothing at all. Here is the first thing you must grasp about that quiet zone. In retirement tax planning, the most valuable moves are the ones you make intentionally, not the ones forced on you by the rules. The IRS is very efficient at designing mandatory requirements. It is not in the business of reminding you about the opportunities that exist before those rules begin. Age 61 is a pure opportunity year. It is the final year before the 3 major retirement income systems, Social Security and RMDs, begin to overlap and interfere with one another. And retirees who understand this use 61 aggressively and deliberately. Those who do not spend their retirement years reacting to choices they never realized they had made. Now, let me walk through exactly what shifts at 62, 63, and later, so you see clearly what you are preserving when you act at 61. At 62, Social Security eligibility begins. This does not force you to file immediately. In fact, most people should not claim at 62. But from the moment you are eligible, Social Security enters every income planning conversation you will have for the rest of your life. Here is why that matters. Even if you delay claiming, the IRS uses a calculation called provisional income to figure out how much of your Social Security check is taxable. The formula takes your adjusted gross income, adds any tax-exempt interest, and adds 50% of your yearly Social Security benefit. That sum becomes your provisional income. Starting at 62, even if you are not yet taking Social Security, every financial decision you consider has to be viewed through the lens of how it will interact with your future Social Security payments. A Roth conversion that would have been straightforward and clean at 61 now requires you to run scenarios about its effect on your projected Social Security benefit, your planned claiming age, and the provisional income calculation. The math does not become simpler, it becomes layered and intertwined. At 63, Medicare enters the frame in a very specific and potentially very costly way. IRMA, the income-related monthly adjustment amount, is a surcharge tacked onto Medicare Part B and Part D premiums when your income passes certain thresholds. That surcharge is based on your income from 2 years prior. Your income at 63 determines what you pay for Medicare at 65. Your income at 64 sets your Medicare premium at 66. The 2026 IRMA threshold for single filers is $19,000 of modified adjusted gross income. For married couples filing jointly, it is $218,000. Going just $1 over that level triggers the full surcharge for that tier. For a married couple where both spouses are enrolled in Medicare, the first tier alone adds around $1,948 per year in extra Part B premiums before even counting any Part D surcharges. At the top IRMA tier, the monthly Part B premium climbs to $689.90 per person per month. Now, here is the 61 connection most people never see. A Roth conversion completed at 61 has zero IRMA effect. Zero. Income you recognize at 61 does not influence your Medicare premiums because the 2-year look back does not start to matter until you are nearing 65. That exact same conversion at 63 could tack on thousands of dollars of Medicare surcharges per year for the next 2 years. Same conversion size, same dollar amount, totally different lifetime cost based purely on which age you choose. This is why 61 is not just an ordinary birthday. It is the final year in which the IRS cannot hit you with a Medicare penalty for aggressively managing your tax picture. Now, I am going to outline the 4 strategies that are open to you at 61 and become far more difficult or impossible to execute cleanly once you reach 63 and beyond. Strategy 1 is Roth conversions while you are still in the 12% bracket. The 2026 federal tax brackets, confirmed on IRS Gov through Revenue Procedure 2025-32, are as follows. The 12% bracket covers taxable income from $12,400 to $5,400 for single filers and from $20,800 to $100,800 for married couples filing jointly. The standard deduction for 2026 is $16,100 for single filers and $30,200 for married couples filing jointly. This means a single filer with no other taxable income can convert up to $66,500 from a traditional IRA to a Roth IRA and pay just 12% federal tax on the entire converted amount. A married couple with zero other income can convert up to $133,000 and still remain fully within the 12% bracket. The step up from 12% to 22% is the single biggest percentage point jump in the federal bracket system. It is a 10-point jump. On a $50,000 conversion, the difference between a 12% rate and a 22% rate is $5,000 more in federal tax. Over a decade of conversions, that adds up to $50,000 or more in additional taxes. At 61, with no Social Security income yet, no pension if you have not retired, and no RMDs for more than 10 years, your taxable income might be the lowest it has been in your entire adult life. The amount of bracket space you have available at 61 may never be this wide again. Each year you move past 61, that space tightens. Social Security payments begin, pension checks start, RMDs at 73 become unavoidable. By the time most retirees realize they should have been doing Roth conversions, the generous bracket space they had at 61 is mostly gone. Strategy 2 is using the 0% long-term capital gains bracket. In 2026, long-term capital gains are taxed at 0% for taxable income up to $49,450 for single filers and $98,900 for married couples filing jointly. These income levels are calculated after your standard deduction. This means a married couple at 61 with $100,000 sitting in a taxable brokerage account that has grown in value significantly can sell and realize those gains at a 0% federal tax rate as long as their total taxable income, including the gain, stays under $98,900. Let me show you how this works with a real-world illustration. Thomas and Carol, the Tennessee couple we will examine more fully later in this video, have built up a taxable brokerage account over 3 decades of investing. They purchased index funds in 2001 for $20,000. Those holdings are now worth $95,000. That is an unrealized gain of $75,000. If they sell those funds in a year when their taxable income is under $98,900, the entire $75,000 gain is taxed at a 0% federal rate, 0% on $75,000 of gains. That is a tax bill that in any of their working years would easily have been $15,000 or more, reduced to nothing because they managed their income below the threshold at 61. But there is an even more powerful strategic step built into this. After realizing the gain at 0%, they can immediately reinvest in identical or nearly identical investments, resetting their cost basis at $95,000 instead of $20,000. From that point forward, every dollar of profit on those assets starts from the higher basis. They have permanently reduced the taxable gain built into those holdings for any future sale, while avoiding any wash sale problem because this was not a loss harvest. It was a full exit and re-entry at 0% tax. If you are completing Roth conversions at the same time, you have to coordinate carefully because each dollar you convert raises your adjusted gross income and shrinks the space available for 0% capital gains. But at 61, you have maximum freedom to choreograph this because no other retirement income systems are crowding the picture. At 63, a sizable capital gain or Roth conversion can push your income across an IRMA threshold, layering nearly $2,000 per year in added Medicare surcharges per couple on top of the tax bill itself. At 61, that hidden cost is not in play. Strategy 3 is optimizing ACA marketplace health insurance subsidies. If you are 61 and retired or partially retired and not yet on Medicare, you are in a 4-year stretch where your income determines whether you qualify for premium assistance on health insurance through the ACA marketplace. In 2026, the expanded ACA subsidies that had been available since 2021 have expired. The subsidy cliff has returned. To qualify for premium tax credits in 2026, your household income must fall between 100% and 400% of the federal poverty level. For a single person, 400% of the federal poverty level in 2026 is about $60,240. For a married couple of 2, it is about $81,760. This means that at 61, if you are managing your income to stay under that 400% threshold, you might qualify for substantial premium tax credits on ACA marketplace coverage for as many as 4 years before Medicare takes over. The exact dollar value of those credits will depend heavily on your age, where you live, and which plan you choose. But at 61, full price coverage can easily run several $100s to more than $1,000 each month per person, so qualifying for subsidies is a big deal. The key interaction is this: every dollar you convert from a traditional IRA to a Roth counts toward your MAGI for ACA subsidy calculations. So at 61, you are juggling a 3-way balancing act: Roth conversion income, capital gains harvesting, and ACA subsidy eligibility. This is not simple, but it is absolutely manageable at 61 when no other retirement programs are distorting the picture. At 65, Medicare replaces ACA plans entirely. At 63, income you recognize can affect IRMA 2 years later and ACA subsidies right now at the same time. At 61, you can align all 3 levers cleanly with full visibility and full control. Strategy 4 is designing a proactive income floor for the next 3 decades. This is the move most people completely overlook, and it is the one with the biggest long-range financial effect. Here is how to frame it. Every pre-tax dollar inside your traditional IRA today is a dollar that will eventually be forced out through required minimum distributions starting at age 73. Your RMD is found by taking your account balance at the end of the previous year and dividing it by a life expectancy factor from the IRS tables. At age 73, the factor on the Uniform Lifetime Table is 26.5. So if you hold $500,000 in a traditional IRA at 73, your first RMD will be about 18,868. But here is why this is a 30-year issue, not a single-year concern. If your account grows between 61 and 73, your RMD will be larger. As the factor declines with age, which it does, the required percentage increases each year. At age 80, the factor drops to 20.2. If your account has grown to $700,000 by then, your RMD climbs to about $34,653. That mandatory income stacks on top of Social Security, on top of any pension or other income, pushing an ever-growing portion of your total income into taxable brackets year after year. Retirees who reach 73 with large unconverted traditional IRAs have essentially no flexibility. The RMD must be taken whether they need the cash or not. Every dollar is taxed as ordinary income. If those RMDs lift their total income beyond the Social Security provisional income thresholds of $34,000 for single filers or $44,000 for married couples filing jointly, as much as 85% of their Social Security benefit becomes taxable on top of the RMD. Each dollar you convert from your traditional IRA at 61 shrinks the future balance that will be subject to required withdrawals at 73. Each dollar moved into a Roth at 61 grows tax-free and is never subject to RMDs during your lifetime. Roth IRAs have no lifetime RMD requirement. The arithmetic is simple. A dollar converted at 61 at a 12% federal rate costs you 12 cents today. That same dollar left in the traditional IRA and forced out in an RMD at age 76 at a 22% effective rate costs you 22 cents. Over $100,000 of total conversions spread over the coming years, that is a $10,000 difference in federal taxes alone. But the real long-term benefit is larger because the converted dollars compound tax-free in the Roth for the next 3 decades, growing with no future tax drag. Let me make this clearer with a full 20-year projection. Patricia, from the story at the start, holds $480,000 in her traditional IRA at 61. If she does nothing and the IRA compounds at 7% per year through age 73, her balance at 73 will be about $127,000. Her initial RMD at 73, using the 26.5 factor from the IRS Uniform Lifetime Table, will land around $38,800. That $38,800 required withdrawal stacks on top of her $12,000 annual pension and her roughly $22,000 per year Social Security benefit when she files at 70. Her total income during the first RMD year is roughly $72,800. Her provisional income is her AGI of $72,800 plus half of her Social Security benefit, or $11,000. That produces $83,800 of provisional income, well above the $34,000 single threshold where 85% of Social Security becomes taxable. At 85% inclusion, $17,000 of her $22,000 Social Security benefit is taxable. She is paying ordinary income tax on her RMD, on most of her Social Security, and on her pension. Her federal income tax bill in that first RMD year runs around $12,000 to $14,000 on money she might not even need to spend. Now see what happens if she converts $80,000 per year between ages 61 and 64. That is a 4-year window with a total of $320,000 converted. Her traditional IRA balance at 61 falls by $80,000 per year across those 4 years. By 65, she has moved $320,000 to Roth, and her remaining traditional IRA, growing at 7% while she converts, is about $300,000 instead of $700,000. By age 73, that remaining $300,000 has grown to roughly $640,000, assuming the same 7% rate. Her first RMD is now about $24,950 instead of $38,800. Her total income is lower. A smaller slice of her Social Security crosses into the 85% taxable range. Her lifetime federal tax burden drops meaningfully. Meanwhile, her Roth IRA, which received the $320,000 of conversion starting at 61, has grown to around $800,000 by age 73 at 7% returns. Every penny of that $800,000 is tax-free. No RMDs, no tax on withdrawals, no IRMA effect. Retirees who treat 61 as a planning year do not just save money immediately. They engineer an income floor that gives them enormous flexibility over the next 30 years. Those who ignore 61 spend those same decades executing orders from a system that is essentially telling them what to do. Now let me tie all of this together with a real scenario so you can see the numbers in context. Thomas is 61. He left a manufacturing job in Tennessee at age 60. His wife Carol is also 61 and recently left the workforce. Together, they hold $700,000 in traditional IRAs split between them. They are not taking Social Security, they have no pension income, and they are covering expenses using savings and a modest stream of dividends from a taxable brokerage account. In 2026, before any Roth conversions, their total taxable income is about $18,000 after the $32,200 standard deduction. Their taxable income before converting anything is effectively zero. They have $800 of room left in the 12% bracket. Thomas and Carol choose to convert $100,000 from their traditional IRAs to Roth IRAs in 2026. Their total taxable income becomes $100,000. They owe about $9,000 in federal income tax on that conversion at an effective rate well below 12%. Because the lowest slice of income is covered by the 10% bracket and the standard deduction. That $9,000 tax bill is purchasing a permanent tax-free environment for $100,000. At a 7% annual average return over the 12 years leading up to RMD age, that $100,000 grows to about $225,000 inside the Roth, entirely tax-free. Their traditional IRA pool now sits at $600,000 instead of $700,000, which means their eventual RMDs will be proportionately smaller. They also remain well under the IRMA threshold because their total income, including the conversion, is $100,000, which is $118,000 below the $218,000 joint IRMA threshold. No Medicare surcharge at all, and because they are not yet 63, the income they recognized at 61 has zero IRMA look-back consequences. Now consider what happens if Thomas and Carol wait until 63 to do that same conversion. The income shown at 63 will be used to set their Medicare premium at 65. If they convert the same $100,000 at 63, their MAGI for that year becomes roughly $118,000, counting other income. That is above the $19,000 single IRMA threshold. But for their joint filing case, the threshold is $218,000. In this particular example, they still stay under the joint cap. But if either of them receives any extra income from a pension, side work, or other source, or if they feel the need to convert a larger amount to catch up for the years they waited, they run the risk of crossing that threshold and triggering a 2-year Medicare penalty. Those 2 extra years of waiting also mean 2 additional years of growth inside the traditional IRA at pre-tax status, which increases the balance, which increases future RMDs, which makes the problem harder and more expensive to solve. Each year of delay does not simply postpone the problem, it makes it bigger. Before moving forward, if you are still with me right now, it tells me you already recognize that the choices that truly transform your retirement are the ones you make before the system starts making them on your behalf. That is exactly who this channel is built for. Tap the like button so this video can reach more people who need the information. And subscribe if you have not already so you never miss this kind of deep dive content. Now let us talk about what happens to people who miss this 61 window entirely. The most typical pattern looks like this. A person turns 61. They are either still working or have just recently stopped. They do not feel any urgency because nothing external seems to demand it. No notices from the IRS. No forms requiring action. No immediate penalty for ignoring age 61. So they do nothing. Now I want to be very clear about the 3 most predictable errors that tend to follow when someone skips this window, because these do not occur randomly. They repeat in a pattern. The first mistake is starting Roth conversions too late and at amounts that are too large. When retirees finally realize they should be converting, they often try to make up for lost time with an enormous 1-year conversion. A couple who waits until age 65 to begin might attempt to convert $300,000 in one shot to cover the 4 years they skipped. That single $300,000 conversion adds $300,000 of taxable income in 1 year. It pushes them up into the 22% or 24% tax bracket. It drives their Magi far beyond the IRMA ceiling, triggering a Medicare surcharge for the next 2 years. It may also cause up to 85% of their Social Security to be taxed if they have already started benefits. A conversion strategy that should have been spread over 4 or 5 years at a 12% rate becomes compressed into a single year at a much higher average rate, with Medicare penalties stacked on top. The cost of catching up is always higher than the cost of planning ahead. The second mistake is only discovering the RMD issue when they reach 73. A retiree shows up at 73 with $800,000 or even $1 million in a traditional IRA. For decades, they were told to maximize pre-tax contributions. They followed the rules they were given. Now, the IRS requires them to pull out $50,000 or more each year whether they want the money or not, and every dollar is taxed at ordinary income rates. At this stage, their choices are limited. They can still do Roth conversions on top of the RMD, but the RMD itself devours most of their low bracket space. They can use qualified charitable distributions to send up to $111,000 of RMD income per year directly to charity if they are charitably inclined. But they cannot unwind the decades of compounding that built such a large pre-tax balance in the first place. The retiree who converted aggressively at 61 does not face this bind. Their traditional IRA is smaller. Their RMDs are under control. They are not constantly on the defensive. The third mistake is failing to plan for what happens to the surviving spouse. At 61, both spouses are usually alive and mapping out retirement together. When one spouse dies, the survivor must file as a single taxpayer starting in the following tax year. The IRMA threshold falls from $218,000 for joint filers to $19,000 for single filers. The Social Security provisional income threshold drops from $44,000 to $34,000. If the couple shape their income strategy around joint thresholds, the surviving spouse is suddenly facing significant overexposure. A Roth conversion plan created at 61 that deliberately accounts for this survivor scenario will look very different from one that ignores it. And this planning can only be done smoothly while both spouses are living and income is still relatively low. At 61, that window is wide open. The standard progression looks like this. Someone turns 61. They are still on the job or just recently left. They feel no urgency because nothing in the mail or in their inbox is signaling a deadline. No IRS notices, no Act Now messages, no sanction for disregarding age 61. So they wait. At 62, they become eligible for Social Security. They begin wondering when to claim. Every income planning conversation now involves modeling Social Security timing. At 63, they finally do a large Roth conversion because a friend or advisor tells them they should. But now, the income from that conversion appears on their 2023 tax return, which the Social Security Administration and Medicare will review in 2025 when they sign up for Medicare at 65. IRMA surcharges kick in. They pay more for identical coverage. At 65, Medicare coverage begins, and their premium is pegged to income they had no idea would matter. At 73, RMDs start. Their traditional IRA is larger than it would have been if they had reduced it during the lower income years. The RMDs shove them into a higher bracket. Social Security becomes 85% taxable because their provisional income is far above the threshold. Every single one of these outcomes flows directly from the decisions they did not make at 61. None of these events is shocking or catastrophic by itself.